So in this module of the course, I want to talk about some important financial benchmarks, and these benchmarks are they're pretty well recognized in the world of finance, and larger companies pretty much understand these financial benchmarks, but what I find is maybe smaller business owners or smaller private companies don't seem to be too aware of these financial benchmarks, and they're very important when it comes to understanding and how to measure and monitor and pull on the value of the business. So if you want to increase the value of the business, you really have to have a good handle on these financial benchmarks. So let's talk about that in this module of the course. Some words of caution that I would kind of put up there. If you watch a lot of these business shows, and I like watching CNBC just like everybody else, and but the problem, with Wall Street and people who trade rather than invest, people who trade based on things that are very short term, and they don't make long-term decisions and long-term investments, and that's not really going to get you there when it comes to high valuations. So there's a tendency, in my opinion, to put a little too much emphasis on earnings or net income. It's kind of like, it reminds me of kids addicted to sugar, you can't get enough sugar, and you get that sugar rush, and all of a sudden the company announces its earnings, and Wall Street, yeah, their earnings are up, and you get that little sugar spike, and maybe the price of the public company goes up for a few days, but then it comes right back down. And the problem, earnings is very manipulative. It's not really reflective maybe of what is going to help you increase the value of your business. So just because your earnings, your net income goes up doesn't necessarily mean that the value of the companies are going to go up over time. And a much better indicator of this might be the free cash flow that I can withdraw out of the business. So Microsoft and other technology companies like Apple Computer, they have a lot of cash flow. And their value, what they're worth, is a lot more than, let's say, a company like General Motors or some company that has a lot of hard fixed assets. So you can have a lot of assets and you can have earnings, but unless you have cash flow, which means you have an opportunity to make long-term investments that are critical to growing and increasing the value of a business long-term, then that's why you have to think in terms of free cash flow. Like Microsoft or Apple Computer, they don't have any more assets than General Motors, but their value, their market capitalization on the stock exchange is much higher than General Motors or other companies that have a lot of hard fixed assets. So when we go out and we look at investments and long-term investments and grow a company, we want to focus on the cash flows and what are the cash inflows and outflows when we evaluate those investments to grow the business, be it a marketing program, a new IT project, or whatever that long-term investment is. So just some basic ground rules, words of caution when you think about this, because I think there is a lot of misconception, and you can certainly get that impression when you watch a lot of the business shows on TV. In fact, if you take this one step further, investment bankers are smart, and they're smart because they don't move away from these principles of finance. So, earnings per share, the earnings of a company, the correlation between the earnings of a company and the value of a company, according to one investment banking firm, is only 1%. The correlation is very low. On the other hand, return on investments, if you can generate return on investments that are very positive and strong with the long-term investments you make to grow the company, then the correlation between ROI and the value of the business is much higher, 75%, according to a study from one of the investment banking firms. So the correlation between earnings and value is quite low, 1% versus 75% for ROI, return on investment. So if you're going to focus on a really important metric to grow your business, you need to know what the ROI, the return on long-term investment, is for that capital investment, be it a marketing program, an acquisition program, a new IT investment, whatever the infrastructure investment is. You've got to focus and figure out what that ROI is on that investment. So just so you know, what exactly, say, what is ROI? Well, let's put it in real simple terms so you can just kind of get a real ballpark understanding. Take the residual benefits that you have left over after you invest in something and divide it by the total amount of the investment over the life cycle of that investment. So if I invest $100,000 in a house and I sell the house 5 years from now at $120,000, the residual benefits is $20,000, right? 20,000 divided by 100 is 20% ROI. Very simple calculation. So we want to account for all of the cost to place the asset in service, all of the cost over the life cycle to service that investment. And then we have to figure out what the benefits are over the life cycle of that investment. So we have to quantify the benefits and the costs of that long-term investment to figure out what the ROI is. If you look at the macro enterprise-wide level, then you can get a little bit of a rough ballpark understanding of what your return is at the company-wide level. Just go to your income statement, your balance sheet, divide net income off the income statement, and take the average equity for the year. So whatever the ending balance for equity on the balance sheet is last year, this year, whatever the average of that number is, take net income and divide it by that to get some idea of what the return you provide to the equity owners of the business by simply looking at the financial statements themselves. So you've got to understand and analyze ROI, return on investment, to increase the value of the business, because there's a much higher correlation between that and value than anything else. You've got to understand that, and that's why investment bankers really make a lot of money. They understand this principle of finance. And just to give you an example, let's just go through a quick example. Suppose you have a new capital improvement project where you want to actually go out, you want to build a new facility, a retail facility, and it's going to cost you $23 million. Then it's going to cost you an additional amount of money to maintain that, around $2.5 million per year starting in year 3. So what we've got to do is we've got to quantify all of the costs over the life cycle of that investment. But at the same time, we'll realize some benefits once we get that operational. Once that facility is rented out, we've got throughput. We can collect rent of $3.6 million per year starting in year 3. We also get a tax deduction write-off of $4,500,000 in year 1 as an incentive to make this $23 million investment. And we expect to increase our business opportunities in year 1 to $10 million and $6.5 million in year 2. So for purposes of looking at this investment, we'll look at it over a 10-year life cycle. So what we want to do is we'll put all of our costs, all our benefits down, try to quantify all of that out over the life cycle, put it into a spreadsheet or a matrix or some kind, so you can kind of figure out what your initial cost would be and your cost to maintain over the life cycle, and you can quantify those costs and the benefits in the box to the left, and then we can calculate the residual benefits. So we can take what the benefits are, $46,200,000 compared to $40,500,000, and the residual benefits are $5,700,000. If we just do what's called a rough order of magnitude or a ROM estimate without discounting, we get a rough idea that's about 14% without any discounting of dollars, just to get some kind of ballpark quick fix on what we're looking at on that capital improvement project for the retail outlet. So that's just gives you an idea without any real complicated discounting of dollars, just to give you an idea. You've got to know how to quantify and figure out ROI, okay? Very important if you want to increase the value of the business. Now, it's a little bit challenging sometimes to quantify the benefits. The benefits can be a lot of things. I mean, you may have you maybe have organizational benefits where you create new customer opportunities, or you're able to service your customers better and retain your customers better. Those things are kind of hard to quantify, but if you can quantify some of those benefits, or even the financial benefits, the fact that you avoid cost, or you increase cash flow or collections, or you have higher production with your operational benefits, or maybe cycle times and hours to complete and all the steps, you eliminate non-value added activities in a process. Or maybe you have some IT, information technology benefits. So benefits can come across a lot of different areas. So you have to take a look at it on a very broad view as to how this is going to impact the company across its operations, financial. Are there any intangible benefits, especially to the customer? Always look at the impact to the customer, to the employee, to the operations, the IT infrastructure, things like that, when you go out there and you try to quantify the benefits to figure out what the ROI of the investment is. Now, you might be asking exactly what is a good or a bad ROI? Well, I calculate the return on investment. How do I know whether the return on investment increases or decreases the value of the company? Well, the litmus test is very simple, actually. You have to know something called cost of capital. And the cost of capital is the cost of the debt, interest paid on debt, less the tax benefit, and the fact that you have to pay a return on the equity owners. So the cost of the debt, which is interest payments on loans, and the cost of the equity, which is the return you've got to give back to people invest in the business, the combination of those two give you an idea of what your cost of capital is, the cost of capital. So if the cost of capital were 10%, then you need to generate a return on investment from your long-term investments greater than 10%. Your ROI has to be greater than 10% to create value and increase what the business is worth. If the ROI is less than 10%, your cost of capital, then it would destroy value, and it would not be a good investment based on the economics that you've calculated. So that's why you go through this ROI calculation. You got to compare ROI to cost of capital to justify it from an economic analysis viewpoint. It doesn't always mean that you don't make the investment. I mean, there are circumstances where you may make investments and take a hit, to comply with regulatory rules, or to realize that this is the right thing to do, and you got to take a hit. And hopefully you get what's called synergy or intangible values by some other opportunity that may or may not arise in the future, so that you're positioning the company for something greater. So these are some important concepts to take into account when you look at investments and try to increase the value of the business. Now, calculating cost of capital is a little tricky. What you would have to do is you need to know all of the interest-bearing components of debt. So if you have a short-term loan and it's 8% interest, and you have a long-term loan and it's 7.5% interest, and you have a long-term mortgage at 6.5% interest. But you also get a tax write-off for the interest that you pay. So you would actually have an effective rate for debt components is going to be net of the tax benefit. So if, for example, let's just say your tax bracket rate is 28%. If it's 28%, that's a benefit. So the real interest rate that really you're paying out of pocket is less than the face or nominal interest rate on the loan. So because you're deducting interest at a 28% tax rate, that means what's really the effective rate that you're paying is like 8% times 0.72 is 5.76%. That's the effective rate that you really pay out of pocket for that short-term loan. So we want to calculate the effective after-tax rates for all interest-bearing components of debt to figure out the cost of capital. The cost of the equity owners is going to be much trickier, because here you got to figure out what kind of return, how much do I have to guarantee, what do they expect? Well, I can get 6 or 8% maybe long term by investing in the stock market or other investments. The higher the risk, the higher the return that those equity owners are entitled to or expect. So if they expect to cash out in 5 to 7 years at above, let's say 6 or 8%, then that's probably going to be 15, 20%, or maybe even higher, because your business is very small and a lot of things can go wrong. So the risk goes up. And as the risk goes up, that required rate of return for the equity owners goes up quite a bit. So this is very difficult. It's not an easy calculation. But if you can plug something in for the equity owners and those debt components, then what we can do now is we can figure out what the cost of capital is. Now, for publicly traded companies, the exercise is a little easier because a publicly traded company knows what its risk-free rate is and what its risk factor is by using something called the beta coefficient. So there's that actual formula called the capital asset pricing model that will help publicly traded companies figure out what their cost of capital is. And that formula is based on the risk-free rate plus what's called the beta coefficient times the market return, such as what return you get from the Standard & Poor's 500 less the risk-free rate. That beta coefficient fluctuates with the marketplace. So if a company is a high-tech company, it probably is going to be riskier. Its beta coefficient fluctuates more than the average overall stock market, right? And if a bank or a more stable company, like a utility company, their price won't fluctuate as much as the market moves up and down, so its beta coefficient would be below 1.0. So this would be a formula that you could actually use if you had a publicly traded company. So if you had a beta of 1.35 and the overall market return that people expect going forward is about 12%, and let's say the risk-free rate, which in this example is quite high given how low interest rates are now, but we'll use the 6.5% as an example of a risk-free rate, which is high, but just using that in the formula, 6.5% plus the beta 1.35 times 12% less the risk-free rate, 13.9% would be the calculated cost of capital for the publicly traded company. So we could punch these into our formula to calculate the overall weighted average cost of capital. So we would want to weight each of the components, which basically means that we have a certain portion of our capital structure as short-term loans. Let's say it's $36,100. And the long-term loan, the capital structure, it amounts to $68,500. The mortgage loan is $290,000 and the equity is $330,000. If I divide 36,100 divided by 724,600, that gives me 4.98%. 4.98% times 5.76% is 0.29%. That's less than 1%. Okay? So that's less than 0.5%. And if I work that out, and again, long-term loan is 5.4% times 0.0945 would be 0.51%, about 1/2%. And you work all that out and then you sum them up. 0.29 plus 0.51 plus 1.87 plus 6.33. And that gives me an overall weighted cost of capital of 9%. So what I'd have to do going forward, this company needs to earn ROIs greater than 9% to increase the market value of the company. So you got to know ROI, and you got to know weighted average cost of capital, and you compare ROI to weighted average cost of capital, and that's the litmus test that you got to use when you do economic analysis. And this is what I mean by important benchmarks that you should understand and use to analyze and figure out, am I making an investment that increases or decreases the value of the company, what it's worth? Okay, so that's what I'm trying to get across in this module 3, this financial benchmark part of the course. Okay, so just so you'll know, a lot of times investment bankers may quickly size up a benefit stream for a company at the enterprise-wide level or a company-wide level. And what they will do is they'll come up with something called earnings before interest, taxes, depreciation, and amortization, or we'll abbreviate that as EBITDA. So they'll add back interest on debt, taxes, state and federal taxes, because they are the most common non-operating expenses, and then they will add back non-cash flow expenses, and the two most common ones are depreciation and amortization, and that gives us, in our example, EBITDA, earnings before interest, taxes, depreciation, amortization of $2,800. So it's not uncommon for a company to at least start with the EBITDA number as a value as a benefit stream to assign value to a private company. So you will see that, and then they'll make some adjustments, usually 3 to 5 adjustments, to kind of maybe give it a more forward-looking EBITDA number to kind of go through the exercise for figuring out what the value is. So, and the point that I would make about this EBITDA, you say, well, why do I care about EBITDA, and what does it really matter, or why should I care about it? Well, here's the thing that I would stress to you, is that private companies will typically, historically, have sold for a multiple of their EBITDA number. So in the United States, for example, there are about 5.4 million small businesses that have about upwards to 5 million in annual sales revenue. And then we have what we call middle market private companies, and there's about 300,000 of those in the United States. And their annual sales revenues are between $5 million and $1 billion. And you can kind of subdivide those up into lower, mid, and upper. And then to the right, you have large publicly traded companies that have $1 billion or more in revenue, sales revenues, okay? The point I'm trying to make is, typically what happens is a small business with less than $5 million of sales revenues is going to sell for around 2 to 3 times its EBITDA number. And the thing that, how investment bankers really make their money, let's think about it. They have a buy left, sell right strategy, which basically means they come in, they acquire a small business on the left side of the scale, and they grow it and move it to the right, and they sell it at a higher multiple. They combine it with another company, they bring in a new management team to turn it around. And that's pretty much how investment bankers make their money, through merger acquisitions and things like that. So that's what I'm trying to convey to you in this chart, is the EBITDA number is very much rooted in how investment bankers work and do deals in the world of private capital. So if you're a private business owner, you should be aware of this, and there's a lot more information that you can get from the Private Capital Market book that's published by Rob Slee that I would recommend. But just to recap on this module, is that the thing I wanted to stress is cash flows is very important to figuring out the value of investments that are long-term. Don't get addicted to earnings, because the correlation between earnings or net income is not very high with the value of the business. And there's a real cost to financing and funding the business, and that's going to come in the form of debt and equity, and the combination of those two forms the cost of capital, and that's an important benchmark that you've got to know. People in finance who are sophisticated, like chief financial officers of publicly traded companies, they know what their cost of capital is, but most private business owners don't, and it's something that you should talk to your CPA or your advisor about and get a handle on that, so you can get a better idea whether you're really increasing the value of your business, because that's kind of where your personal wealth resides, is what your business is worth. So that's why you should care about it. And obviously the third point I'll make is your long-term investments that you make in your process, your people, your business, you want that ROI to be higher than the cost of capital. And that's the fourth point, is that's how investment bankers and other people in finance are going to view your business. You may not like it, and no one likes being told that reality, but The sooner you get aligned around that reality, the better, because that's going to help you grow your business, increase the value of their business, and eventually you can cash out at a real high multiple, which is what you should be thinking about as a business owner, some type of exit strategy at some point in time. So that's module 3 on the financial benchmarks. Now we'll move to the next module in the course.